Want a way to make money in crypto that doesn't depend on guessing whether Bitcoin goes up or down? Then you need to understand arbitrage. It's a strategy that doesn't bet on direction. It bets on market inefficiencies. In plain English, arbitrage means buying an asset where it's S cheaper and selling it where it's S more expensive. Trying to capture the difference. In crypto, this happens because markets run 24/7. There are tons of exchanges, and liquidity isn't perfectly balanced everywhere at the same time. The appeal of arbitrage, when it's done properly, is that it feels more like a business than a casino. There are 3 reasons for this. First, there's less dependence on predicting future prices. You don't need to be right about where the market is going. Second, you look for many small opportunities, repeatable micro edges, instead of waiting for one perfect trade. And third, it forces discipline, fees, execution, risk management. Arbitrage makes you think like an operator, not a gambler. So, what are the common types of crypto arbitrage? There are a few main flavors. First is exchange to exchange, or spatial arbitrage. This is when Bitcoin is cheaper on exchange A and more expensive on exchange B. You buy low and sell high. It sounds easy, but the execution is where most people get wrecked. Second is triangular arbitrage, which happens inside one exchange. You exploit pricing differences between pairs, like trading from USDT to ETH, then to BTC, then back to USDT, trying to end up with more USDT than you started with. This can be faster because you don't have to move funds off the exchange. Third, we have spot versus futures arbitrage, also called cash and carry. Sometimes futures trade above or below the spot price. Pros: try to lock in that spread with hedged positions. This is more advanced, but it's very common with serious traders. And finally, funding rate arbitrage, which applies to perpetual markets. These markets pay a funding rate that can favor one side. This isn't free money. It's about capturing an imbalance between long and short positions. Now, here's the real math. How do you actually know if it's profitable? A 0.4% spread is not automatically profit. You have to subtract trading fees for both buying and selling the spread, and slippage because you might get filled at a worse price than you expect, withdrawal and network fees, and time risk because the price can move against you while you execute the trade. In arbitrage, the market doesn't kill you. The hidden costs do. This brings me to the honest part. Why most people fail. Beginners lose money trying arbitrage for a few key reasons. First, the opportunities can last for mere seconds. You're slow, it's gone. Deposits and withdrawals can take time, and the price spread can flip while you wait. You also have to deal with limits, KYC delays, and exchange maintenance. Real-world friction is constant. There's counterparty risk. If an exchange freezes, your capital gets stuck, and you're competing with bots and professional market makers. So, good arbitrage isn't a trick, it's a system. So, how can you use arbitrage to build capital intelligently? If that's your goal, you need to think like this. Start small and treat it as a skill-building exercise. It's better to try in-exchange strategies first, like triangular arbitrage, to reduce your transfer risk. And use one simple rule. If the profit disappears after you account for all the fees, it's not an opportunity. If something sounds like infinite free money, it's usually a trap. The execution or the risk will bite you. Arbitrage won't make you rich overnight, but it can help you grow capital with a business mindset, focusing on margins, repetition, and risk control. If you're interested, let me know in the comments. And I'll do a part 2 with a crypto arbitrage checklist, what to verify before entering a trade, so you don't lose your profits to fees, slippage, or transfer delays.